Inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain.
The Federal Reserve sees a lack of further progress on inflation. I'm Lisa Bernhard with Reuters, and joining me today is Eric Diton. He's president and managing director of the Wealth Alliance. Eric, it wasn't that long ago when investors thought that they might see a rate cut today. That obviously didn't happen. Talk us through the tone and the language that we saw in the Fed statement today.
Let's start with a quote that stuck with me throughout my 38 years of doing this. There are two groups of people: those who don't know where interest rates are going, and those who don't know that they don't know where interest rates are going. And even Jay Powell is in the first group. He doesn't know where interest rates are going. You ask him, he says, I'm data dependent. And he is. So not long ago, he was telegraphing 3 rate cuts, and lo and behold, the economy's strong. Unemployment down. Labor market looks great. GDP, even though it was a little weak, still solid. A lot of strong numbers out there. Retail sales. So the bottom line is, we've made a lot of progress on inflation. We came down from 9.1. We're in the 3s. That's great. He wants 2. He wants 2. We're far off from 2. So we were kind of lockstep, Lisa, going down, and we've stopped. The progress has stopped. And that's the tone. The tone is, this isn't bad. We've come a long way. And he even used the term, this is better balance. What's he talking about? His dual mandate. He wants price stability, and he wants maximum sustainable employment.
Okay, so we're starting to actually see some chatter that, to your point, we're not near the Fed's goal of 2%, that perhaps they would even hike rates again. Do you see that as a possibility?
No. We are seeing some signs of a slowing economy. GDP was weak. The Chicago PMI came out, lowest number we've seen in a long time. There are signs of a slowing economy. Even just anecdotally, look at the announcements yesterday. McDonald's saying that lower income people, they're having a tough time. Starbucks, right? That's another like luxury item to have that $5 latte. They saw bad numbers. So you're starting to see that we're running out of that carefree spending attitude. So in order for the Fed to really do an about face and start hiking, I think you'd have to see inflation numbers getting up into the mid and high 4s, just a real turn. Right now, we stopped making progress, but we didn't really turn. But if it turned up, that's where the Fed would have to really reconsider. I don't see it.
Okay, I know in this environment that you like bonds and you like dividend stocks. You also like MLPs, small caps, and you like emerging markets, India and Mexico. I'm going to ask you to explain MLPs for those who don't know, and why you like those, and particularly talk us through India and Mexico investments.
Sure. So MLP is Master Limited Partnerships, and that's a structure that basically was allowed by the U.S. government for energy infrastructure. This is pipelines, storage, energy transfer, and the reason that the government gave big tax benefits was because it wanted to promote energy growth. This goes back, remember, in the 70s, we were stuck. There was an Arab oil embargo, and we had a huge problem. We don't have those problems anymore. And part of that is because of the tax benefits of MLPs. So these pipelines that move oil and gas throughout the country, they're like toll booths. They're very predictable. They have pretty constant volume, and they charge a toll. And they pay most of that out in the form of dividends. And the great news is that the majority of those dividends are treated as return of capital. And so they're not taxed. It actually reduces your cost basis. And when you sell it, most of it's taxed as a long-term capital gain. But before you sell it, you could be getting 7, 8, 10% income and not paying tax or paying minimal tax. So we like that, especially given that the US is now the biggest energy producer in the world, and we're exporting huge amounts of gas, especially to Europe, because of what's going on with Ukraine. So that's big income. We've seen growth in that area. Tax benefits, home run. Now, emerging markets, why India and Mexico? Well, if we see what's going on with China, and we see that we've got issues, and our relationship is getting worse and worse, what's happening is that manufacturing is leaving that unfriendly environment, and we're looking for other areas. India is interesting. It's less expensive. A lot of people there speak English, easier to deal with. They are a democracy. They're promoting growth of business, and that's extremely attractive for U.S. companies that want to manufacture elsewhere outside of China. I mean, Southeast Asia is a beneficiary too, but India has been big growth there. India also has tremendously great demographics. They have the biggest part of their population in their 20s. So they're coming into the work environment. And when you go back and look at countries that have demographics like that, the growth follows. So I think they have the best demographics in the whole world right now, India. Mexico, same story. If you don't want to manufacture in China, what better place than right just south of the border? So easy. You don't have those huge transportation costs. You can go visit, easy to fly there, etc. And very inexpensive labor. So we're actually seeing a lot of manufacturing move to Mexico. The MXF, the Mexican fund, has actually been doing well, pays a nice dividend. So those are two exciting areas in emerging markets.